Looks like U.S. rent tumbles the most on record. Yes, the rental market is actually crashing right now, if you can believe that. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate because we all need a good dose of that. Today's the 3rd of November. Lots going on. Literally, I could be doing multiple videos a day and all the things that are happening. Breakneck speed, the market's changing. But first of all, if you want to check out my new report, it's called From Bubble to Correction, then Crash to Crisis, How the Housing Market Imploded in 6 months. Send me an email. I'll fire the report back, okay? Sounds good. All right, so this just came out. Essentially, the Fed had their sort of, meeting the other day, and ultimately, the rent inflation is still far away, is what I guess you could say they think is happening. At some point, you'll see rents coming down. But the difference is that, we've had exponential rent increases the past year or so. Last year and this year, it's kind of mellowed out a little bit. But what's going on now is we've seen rent crashing. So the difference when the Fed does all their analysis and they do their CPI and they look at housing, so rental is used as, I guess, their CPI, metric for housing. Well, there's a lag time. And I guess that's the difference. So the Fed looks at historical data, which is typically maybe 6 to 9 months back, and says, okay, yeah, we see this becoming a problem. Well, we who live in the real world and are dealing with real estate on a daily basis already know that it is a problem. It's not becoming a problem, it is a problem. And we're going to start to see changes that are happening far before the Fed can catch up with this. So what's actually happened is we've had a big month-over-month change in the national rent index. So the chart here is from apartments.com and or apartment list, whatever that is. Anyway, you can find it on the internet. But the point, though, is that you can see, how 2021 we've seen massive rent increases, massive rental appreciation. It dipped a bit, and then again we saw it a bit for 2022, just not as robust as 2021. But it's pretty tough to So again, we're already piggybacking on 2021 increases, but you can see that the past couple of months we've seen a significant decrease, dip in rental rates. So the whole point, though, is that I guess you could say national index fell by 0.7% over the course of October, making the second straight month-over-month decline, the largest single-month dip in the history of our index going back to 2017. So what does this mean? It means people are getting tired and people are getting priced out everywhere. The past 2 months have marked a rapid cool down in the market. It's going forward is likely that rents will continue falling in the coming months as we enter the winter slow season for the rental market. So yeah, here we are, we're in November now. And for me, it kind of real estate, all aspects of real estate, things slow down, people sort of become in holiday mode, everything kind of slows down and it picks up in the new year. So as we enter the winter months, expect even more slowdowns here. So obviously the annual change in median rent for 2021 was almost 17.6% back last year. We're tracking at almost 6% right now. So again, tough to go up to almost 18% again. So but the compound still shows that we've had a significant amount of increase over the past 2 years. So ultimately, in the end, so far rents are up 5.9% in 2022. Compared to a record 18% in 2021. Year-over-year growth has decelerated rapidly since the start of the year, but it's still likely that 2022 will end up being the second fastest year of rent growth since they started doing their estimates. So there you go. So again, why is it happening? Cool down of rent growth is being mirrored by continued easing on the supply side, right? So vacancy now stands at 5.5%, a full year of gradual increases from a low of 4.1% last fall. So again, we're getting back to pre-pandemic levels. The recent slowdown has been geographically widespread. Rents decreased this month in 89 of the nation's 100 largest cities. Boise, Idaho, one of the first rental markets to explode in the early phases of the pandemic, saw the sharpest rent decline. So other places like Vegas, Phoenix, Jacksonville, Riverside all seen rent growth of more than 30%, but they're starting to cool down as well too. So now we're seeing these places that have massive growth are kind of reversing right now. And listen, going back to what's happening here is that, the Bureau of Labor and Statistics produces information. The Fed calculates your CPI and they use rental as their housing index. So ultimately, you can see that, there is a delay factor, right? So they're looking at history data, which sometimes the BLS does. What they do is they do produce the data and they have to readjust it a month or two later. so it never is the same. So it's a bit of a tough, I guess you could say, metric to follow. But you can see that the real time is dropping, whereas the delay, the 5 month delay, still shows it increasing. So it's giving false reading, not a false reading, it's giving a historical reading that's being interpreted for now by the Fed and the financial people, when really the actual part of the rental market is tanking right now. And is it good news for renters? Sure, you want stuff to drop, right? When you're in an economy where we are now, inflation, looking at a recession, everything is so expensive. I mean, any savings you can have is perfect. So there comes a point in time, for me, the crux is that there comes a point in time when you have home price appreciation that's out of control. Clearly, it's a bubble, and the bubble's bursting. It's correcting right now. And then as a tag along, you've got rental rates, rental costs. Obviously, people jump in the game. They go, hey, I can charge more because there's home price appreciation going up. I can tag along and drive rent prices up. Well, there comes a point in time where if you're not buying and you're renting, you're going to get maxed out as well too. So you can't buy that new house based on rates. So maybe you can't rent that nicer, better, more expensive place based on rental rates. So simple as that. So you're going to stay put or find other accommodation or share more or move back in with family, take on roommates, whatever. You'll do what you need to do to keep your housing costs down as low as possible. So we're seeing that. So basically what they're saying here is that the 2 month is precisely the 6 to 9 month delayed OER inflation will peak, and the Fed will be hiking with gusto and signaling to the market the terminal rate is 5% or more. This will happen just as the economy goes into a free fall. So what they're saying here is that we are not only 2 months away from rents not only sliding to a record high in 4 months, but if we get there, then the Fed's going to react, and it's going to really hurt the economy very badly. So that's what we got going on. So, again, not good news. Good news for renters, but not good news for the overall housing market and the economy. All right. So, in striking reversal, renters finally hit breaking point, forcing landlords to slash prices. So this is a little earlier article, but again, what we just talked about makes sense. Landlords are going, okay, we got to rein in our rent prices right now because people can't afford them. And I mean, there comes a point in time where it's got to make sense. There has to be a proper balance in the marketplace. You can't overcharge and expect people to be happy paying that. They're going to want more for their money, essentially, right? There's only so much you can do. Sure, it must change from metro and metro, and some local areas will drive higher rent prices than others. But when it comes down to it, we're experiencing record surges in prices from all aspects: housing, goods, services, food, gas prices, the whole bit. So we're getting pinched everywhere we look. So if there's any opportunity to have some reduction in life costs, people are going to jump on that, right? So again, fighting over limited supply of apartments. I know people who, they're getting a huge number of applications, and they know that, hey, what we can do is we can pick and choose the best looking candidates, and we can push the rates up a little bit. So that's what people are doing. That's what they have been doing. But guess what? Things are going to change. I look at it, now we've had the housing bubble, the house price appreciation coming down, and the values coming down. We're now going to see rental markets as well too, which will impact buy prices, because again, if you're looking to buy for investment, guess what? Now your numbers are going to change, right? You're not going to get that cap rate. You're not going to get that cash on cash return that you're thinking of. So it's going to change now, which means you can't buy a home as expensive as it is, because it's not going to make sense for your back end numbers on your investment, you see. So, as much as good for renters, this will help push prices for other property down as well too. But first of all, guys, if you appreciate the information I provide, if you could help my channel grow and hit the subscribe button, I'd really be thankful and appreciative. So thanks very much. And again, if you're not a subscriber, if you are a subscriber, if you could do me a favor and just sort of reaffirm your subscription, because I lose subscribers every day for some unknown reason. All right. So let's moving on here. So interesting enough, yet once again, somebody else is talking about the real estate bubble losing air. And again, I always go back to the start of the year, double-digit appreciation. Nobody could contemplate where we are now. Look, a matter of 9 or 10 months, things have changed. So this actually is an article. It's talking about Peter Schiff. I'm sure most of you, if you're on the internet and looking at YouTube, you've probably seen him, his videos, or seen him speak in other people's podcasts or videos, etc. So basically, he's saying that he believes that artificially low interest rates blew up a big housing bubble. True, but it's actually a bigger bubble than the one preceding the 2008 crash. It's combined with an overall bubble in the entire economy that dwarfs '08. He says this is the makings of a massive financial crisis. All right. So again, when you take a look at it, the people believe CPI will begin to drop because shelter costs are falling. He pointed out just because housing prices are falling doesn't mean shelter costs are falling. Shelter costs are going up, even if it's cheaper to buy a home. What's important that is how much it costs to own a home. And those costs are going up because even if you pay less, you're still going to paying more on your mortgage. So yeah, until the Fed, who keeps on keeping the mortgage rates where they are, I believe they increased it 75 basis points again, either today or yesterday. So it's going to be tough for people to still work on those higher mortgage rates, right? So the fixed rate mortgage for a 30-year mortgage is over 7%. That means even if you pay a little less, your financing cost is much higher. Higher insurance prices, higher property taxes, higher maintenance costs, right? We know property taxes will go up because it'll get reassessed. We know insurance is skyrocketing as well too. Basically, and this is where it gets interesting because I like the take as to what he's talking about here. He pointed out that there is some incentive to strategically stop making mortgage payments because it takes so long for banks to foreclose and actually kick people out of their houses. Meanwhile, people don't pay property taxes and don't maintain the property. By the time the bank completes a foreclosure, its collateral has drastically decreased in value. So all of this has a making of a massive crisis. So that's right. Now, historically, foreclosures have taken a while. It takes a while for the lender to catch up, and based on where you live and your state's foreclosure process and laws, it could take even longer to actually, go from start to finish and actually having somebody get foreclosed on. Realize, though, that they're actually picking up the pace. And what I mean by that is there's no point anymore for lenders to let these things draw out for a couple of years. They're moving forward. So historically, we've seen longer foreclosure timelines. We've seen it longer because of COVID too, because COVID and the pandemic, remember we had a foreclosure and an eviction moratorium. So we had almost 2 years of no foreclosures. Now things are picking up, and I'm seeing things move a lot faster now. So as much as he's mentioned that, that's great. Realize that the foreclosure process will be speeding up in many locations across the country. All right. So again, I love this too, is that you can't afford a new mortgage as rates go up, which is clear. You can't transfer your mortgage from your current home to a new home, nor can the buyer of your home assume your mortgage. So you're kind of stuck, right? They have to take out a brand new mortgage. And so because so many people have such low mortgage rates, they're going to hold off and they're going to stay in their houses for as long as they can. That's right. So, you're still going to have this transfer up or transferring down. You're going to be stuck in your house because you don't want to engage higher prices or higher costs. So this will slow the housing market even further. And it's also a problem for the lenders, he's saying here. Now they're stuck with a money-losing mortgage because rates are moving up, but they're collecting these low interest rates on these mortgages. They're going to lose money on those. But then for the people who don't pay their mortgages because they're so underwater, the bank is going to lose again because now when the bank forecloses, the value is not going to be there. Real estate prices are going to be more of a reflection of the current high mortgage rates than the previous low mortgage rates because anyone buying a house has to pay the high rate. So he's really focused on rates, which makes sense. But one of the things that I always mention here is that we are focused on rates and we're talking about inventory, and we're talking about correction components going on. Nobody even talks about the foreclosure waves that are coming, which will sort of push us over the edge. Now he's talking a bit about what could happen, i.e., if people stop paying their mortgages. So what he meant there was that strategically, there comes a point in time when you look at your mortgage and you go, okay, I'm paying a lot for my mortgage and I maintain this house. If prices, if I paid a premium and I'm paying a high mortgage rate and I see prices going down, why would I continue to pay that? Well, I could just stop paying, save money, and let the lender deal with it on their own. I'm going to come out ahead. That's the thought process for a lot of people. So these were problems of the 2008 crisis. Peter said it'll be an even bigger problem this time. The rates were lower for longer. The real estate bubble is even bigger than the one we had back then. The more concerning is that this now combined with the overall bubble in the entire economy, which dwarfs the bubble we had in 2008. That's why this is a much bigger financial crisis that's around the corner. So I don't believe the Fed's going to sit back and just watch this whole thing play out. It's going to hold off as long as it can to try to maintain as much credibility as it can. But the minute it senses things are about to implode, then it's going to turn on a dime. All right, so we're all kind of watching to see what's going to happen, and we're not too sure. So again, we're running this right now. We're seeing price reductions, price value coming down, rent values and rent rates coming down. We're still seeing interest rates coming up. We're seeing more people getting foreclosed on, more people bailing on their properties right now. I can personally tell you that we've seen a lot of this increasing over the past couple of months. Ever since Labor Day passed, I've seen a marked increase in activity in the distressed side of things. We're working on a bunch of short sales now. We got a lot of stuff in the pipeline happening. We see a lot of things going on. And you know what? It's catching up with people now. All right. There are people with equity in their homes that are just they're not making their mortgage payments because they can't do it. They do have some equity, but the longer they wait, they chip away that equity. And the longer they wait, also as price points go down, they lose that equity. They sort of shrink, you see, closing costs, commissions, whatever. So, the original narrative where, foreclosures, forbearance, people who are facing delinquent and are facing these issues, they're just simply going to sell and walk away because of all this equity. Well, guess what? Equity was very high a couple months ago. The tappable equity number is great, but guess what's happening? As rates go up, means your mortgage payments are less, so you can't tap into that like you used to. And as price points go down to accommodate the increase of mortgage rates, guess what's going to happen? You're not going to have the same equity you do. And as more inventory comes on, you're not going to have as much equity. And if you're not paying your mortgage, that every month that goes by, you're chipping into your equity. And then there's things like escrow, right? Insurance and taxes that are escrowed to your mortgage that the lender still pays on your behalf. So you can see how these big spreads become much smaller, and actually, you don't have what you think you have. And that's the big issue with homeowners. Trust me, I talk to a lot of homeowners. I talk to some people every single day. They think they have more than what they do. They still think that the market is in good shape and that someone's going to show up with a wheelbarrow full of money at their front door and they're going to walk away and ride into the sunset with all this extra cash. This is not happening. And homeowners are waiting too long to take action. They're putting themselves in worse positions where they can't sell a house or they don't have time for it. They have to take discounts, or there's other issues that go on that further makes it a less of an attractive deal. It's going to cost buyers more. So, I deal with this every single day. It's sad how things are playing out, but this is the start of the housing crash. This is what really happened. So as I mentioned, we've seen a lot going on. We have the correction going on with rates and inventory, etc. Now we have rental rates crashing, which will suddenly make the investment side pull back. So they won't buy as much, and they're not going to buy as high, or they're not going to overbuy for sure. They're going to be very careful what they buy. And as I keep saying, reiterate over and over again, the foreclosures are starting to grow. They're not manifesting in the marketplace yet, but they are starting to gain steam and become a larger portion of what's going to be happening in the future. When that hits, that'll change the entire dynamic of the real estate market. So please keep that in mind. All right. Hey, if you want to find out, speaking of what I just said, the foreclosure market, if you want to find out what's going on in your neck of the woods, your backyard, go to gethousingdata.com. That's gethousingdata.com. This is my affiliate link with foreclosure.com, the nation's leader of distressed property listings. You can literally go there, type in an address, type in a county. You can see what's happening anywhere in the country and take a look at what's really going on. So the stuff I talk about, you can verify anywhere in the country that stuff is actually happening right now. The numbers are increasing, guys. Hey, as I always say, looking for more real estate agents to join my firm, looking to expand other markets, have partnerships, looking for investor buyers, private lenders, the whole bit. We are getting very busy. Also, my new foreclosure program is ready to go now. We're doing training sessions now. Really got some really good information. The stuff I'm talking about is pertinent to today's market and the future market, okay? It shows you how to do this, how to navigate this, how to acquire properties, how to do what you need to do to earn income, build wealth, etc., etc. Get in now before the masses, because I can tell you this is the calm before the storm. So anyway, guys, appreciate the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. Reach out to me at that email address, and we'll look forward to speaking to you early next week. Take care.